Good morning, everybody. Welcome to our March Private Company Compensation Panel webinar. We're excited to have all of you here with us, and we want to thank you in advance for making the time to join us. We're excited to share some updated information and data that J.Thelander Consulting Group has pulled together. And before we get started, I'm just going to go around the room and reintroduce all of our panelists. Everyone give a little bit of their background, and then we'll dive in. So as many of you know, because many of your names look familiar as we were looking through the list of attendees, I'm Christine Connors, and I am, after spending 22 years at J.P. Morgan, I am now the president and partner of Epic Capital Group. We are a multifamily office and investment firm. We manage about $4 billion, $2 billion of cash, and about 30 billion of assets that we oversee across 150 core families. And on the minds of almost all of our clients, because all of our clients are entrepreneurs and executives and founders and funders, is really just understanding compensation. And it's kind of an ever-changing world. There's a lot out there, both on the private and the public side. And so I'm excited to be here today with Melissa Taunton of NEA, Mark Fitzgerald of Wilson Sonsini, and of course our infamous J.Thelander with all of the private company compensation and data. Jody is working hard to get her video on because we love seeing her outfit and her hair and her beautiful face, but we were having some tech challenges. So in the meantime, we're gonna, I'll pass it over to Melissa to give a little bit of her background, and then we'll go over to Mark, and then we'll dive in.
Good morning, everyone. My name is Melissa Taunton. I'm a partner at NEA. I've been at NEA close to 8 years now, and prior to that, I was at Coastal Ventures and in operating roles before that. My mandate is really everything people, both internally for NEA, but then also within our 400 plus portfolio companies. So we have one of the largest venture portfolios. We have about 30 billion under management, and we really pride ourselves on being very involved at every stage of our companies with their company building strategy. Obviously, this is hugely anchored in talent and people and the human capital aspect of company building. We invest in everything from seed all the way to growth, and we have public company holdings. So we really do see the full array of compensation questions and just challenges, especially in this market right now. So I'm excited to be a part of the panel. I've worked with Jody and Morgan for many years, and always look to them for their advisory work on how they regard the market, and obviously always anchored in their data.
Perfect.
I will hand it over to Mark. Yeah.
You want to jump in?
Hi, everyone. Mark Fitzgerald. I'm a partner at Wilson Sonsini, Goodrich & Rosati. We're a global law firm focused on technology and life sciences companies. We have over 400 public companies that are clients, as well as over 4,000 private companies. So, in fact, many of our clients, I think, are the basis for providing surveys that give content to a lot of what we're going to be talking about today. I'm East Coast based. Our firm started in Silicon Valley, but we have offices across the globe now. I helped open our Virginia office, which now became our DC office, and currently up in Boston, primarily working with life sciences companies, but it's still a large number of tech companies as well.
Great, thank you. So, Jody, I'd love to turn it over to you. Just, I think despite what we're seeing in the market and the economy and continued kind of layoff, we're still seeing a really highly competitive and tight labor market, driven still by a lot of, kind of the compensation aspects, the cash comp, but you're also seeing a lot on valuation. So would love to just spend a bit of time with you on the data, but then also just trends that we're seeing as we come into what I think is going to be another couple of years of kind of challenged liquidity markets and exits. And so where do we go from there in terms of compensation? competitiveness, retaining, attracting talent, and then also just making sure that everyone is looking out for themselves in terms of their own ownership and optimizing there from an ownership and a tax standpoint. So Jody, we still can't see your amazing face.
I know,
but
we're working.
hear your wonderful voice and your important data that you have. So I'm going to turn it over to you.
Yeah, great. I'm working on another computer to get myself up and running. But in the meantime, thank you all for being here. It's sort of actually interesting to be on a Zoom and not be able to see you all, but I know you can hear and see. I'm confirming you can see the screen, right?
Yes, we can.
Okay, perfect. So listen, we've been doing these webinars now for really, I would get into saying decades. And this is the first time where we've come through something like what we've been through here with the shutdown of offices. And then, of course, as Melissa would, I think, argue that there's been a tremendous amount of competition for talent, which was sort of crazy because nobody really expected that was going to be the outcome. And then it turns out that it was. And then from there, we really saw compensation take a big switch because it moved from where compensation was a little bit of a hang on one second, I'm trying to get up here. A compensation was always a priority, and then it became like these 75th and max numbers and talent. So listen, we've been running these surveys for 25 plus years now. It's hard for me to even believe it. And we are covering our compensation survey. I think the biggest piece is that it's open all year round now, and that piece of it is what's made our data very real time, which, it's important because everyone is very sensitive to what's happening in the market and whether or not this is something that is changing real time. And I think what we're seeing is that the numbers aren't changing dramatically, but what is changing is how people are using the information. Melissa, what would you say in terms of what you're seeing with compensation and the recruitment for talent?
Yeah, we were talking about this before we kicked this off, and I think the greatest challenge right now is equity and how to value equity, and the challenge of retention is certainly in the arena that a lot of these people's equity is underwater. So a lot of employee equity is underwater. So looking at how to give retention grants, how to even reprice the equity based on down rounds. So just an enormous amount of challenges facing chief people leaders, CEOs, and investors who obviously want to continue to build companies, but just navigate these really challenging times that haven't been seen for a very long time. So I think that's the other issue, is the psychology of the market is really interesting. We're seeing a tight talent market for really experienced, I would say, needle moving roles. So the highest value roles, still a super tight talent market. A lot of those candidates are wanting cash guarantees, and they're looking for creative ways to think through equity. There you are.
Yes, here I am. My God.
Yeah. So, I think it's phenomenal that your data is now open year round, because this market is moving so quickly.
Yeah.
And it's literally week by week. And, so interestingly, we keep hearing that we're in a recession. And, I was just in London, and it's very difficult to find office space to rent. And there's construction going on everywhere. And for specific roles, it's incredibly challenging to find the right candidate. So it's a very confusing market. And so I think anchoring on the data, seeing what's been done. And I think Mark has a lot of perspective on this too. We were chatting on it before we kicked off. So maybe Mark can follow up on that question.
Yeah, Mark, if you could fill us in what you're seeing in board meetings and what's happening with your clients.
Sure. A lot of it has to do with what's happening in terms of valuations and deals. And Q4 of, we're partway through Q1, so we'll have to see how that works. But anecdotally, it seems like things are getting a little bit better this quarter. But Q4 of 2022 was the first time we've seen down rounds in financings, private company financings at the levels of like 15 years ago during the global financial crisis. We just haven't, the word down round financing wasn't really in anybody's terminology recently. And what that means for those who are on the call is basically you have, a pre-money valuation based at least on your last finance, the post money from your last financing round. It's been for years just expected that your next pre-money is going to be higher, right? Or at worst case flat. But now things are going down where where the pre-money valuation for this round is below the post-money valuation for the last round. What does that mean? That means that when the preferred investments come in with liquidation preferences, the common is actually becoming a smaller percentage than it otherwise would in good times. And then how does that translate to equity compensation? As Melissa was saying, is that common stock holders are looking for other creative ways to make sure that, especially in later stage companies, if there's an exit event on the horizon, that there's a way to kind of address what they thought their equity was and what they thought that was going to be, and how does that get readjusted in an exit. So we're seeing a lot of that, management incentive plans, carve-out plans, things like that we haven't seen in a long time are going in place.
Yeah, and I don't know how that's affecting the recruiting model as much, but I feel like that is, I'm going to pull up our slides now. 1 second. I feel like, Christine, when you're doing advising clients, how are you looking at the mix between the cash and equity this way?
Well, I think the biggest piece is, making sure that you've got, as we keep telling our clients, right, just the building up the cash reserves, cutting back on the spending on the personal side so that you can continue to maintain your ownership in the company and not have to sell parts of it in rounds leading up to, a liquidity event, because you want to maintain as much as that as you can. So, I think the cash comp is important, but I think for every client, it really depends, right? Like a seasoned executive that's done this a few times, that's had liquidity already, is very happy taking less cash comp, and is also happy taking a little bit more of a risk and exercising options and their grants when they join a company. Other newer executives are a little bit more gun shy there to give up as much of the cash as possible. So it's a little bit dependent on the executive. But right now, cash is king, and especially given that you can buy a 6-month or a 1-year T-bill and get 5% on your money. So people are seeing that as an attractive alternative, just as the time to liquidity gets pushed out farther.
Yeah.
Morgan, I'm going to let you get into the slides a little bit, but I am not able to. I am desperately trying here to pull this up. So I'm going to let Morgan pull up the slide deck for a second and just talk through this because I can see what's here. So let's talk a little bit about the data, as we said. I'm going to move on to the background of the company. So we've been surveying these companies, as we said, and they are covering private company compensation. We have salary increases and bonuses. If you get into the job titles here, you can see that we are covering all the jobs from CEO down to VPs, directors, engineers, sales, marketing, business development. I mean, we cover the gamut in terms of compensation. And I'm going to move into Morgan past job titles. If you get into the industry slide, please. You'll see here now that tech is about not quite half of the companies, which I find so interesting because we used to be more life science oriented. And you can see that biotech and medical device are still coming close to, what do we have, 34, 40, 50, half the companies now are back to being life sciences. And there's a large integration. And Melissa, I know you're seeing this in the recruiting, the mix between folks from tech companies that are moving to life science companies and life science companies that are moving to tech. I mean, what is going on with that?
Yeah, well, I think, life sciences has been seen as a very resilient space. And if JP Morgan this year conference in San Francisco was anything to indicate it was their busiest conference ever. So obviously that industry has benefited enormously really from COVID and changed. There's been so much kind of advancement of care delivery as well in terms of the health tech sector. So definitely a robust life science economy. And I would say right now, definitely in the last couple of months, tech is getting a massive resurgence into the generative AI space. And so if you are looking for engineering talent, there are certain roles that really are still at a premium. Anyone, with generative AI, ML expertise is, can pretty much write their ticket right now. And the number of companies raising in that sector are kind of off the charts. So there's a lot of, I would say, pockets of heat, and certainly some resilient categories like biotech. And I think with all of those, the overlay as well of some roles, CFO still seems relatively in high demand, especially CFOs who've navigated challenge. Very interestingly, I was talking to a recruiter, and anyone who is under 35 in this job market has never experienced a downturn. So getting that, yeah. So getting that, let's call it gray-haired wisdom of someone who's been in the workforce for 15 plus years is extremely valuable right now, because people who've seen the movie before and who are not kind of frozen in fear, and who can really have a playbook for navigating and reserving cash, cutting burn. We've been in a growth at all costs environment for a very long time. So also want to indicate that chief people officer roles are still in high demand and changing in terms of their scope and their breadth and their prominence in the C-suite and a seat at the table on the executive level.
Yeah, Morgan, let's move to the next slide, talk about the total financing raised to date. So you can see on this slide, this is the way that we like to be looking at data, is to look at the, we go from under 5 million to the 200 million plus. And you see that the 200 million plus information has really changed. Are you seeing that slide?
Not yet.
No, still on the industry.
Yeah, let's move to the next slide of the total financing raised to date. I'm really sorry that we're having technical difficulties. This is like it's the worst possible case scenario here. Okay, perfect. There we go. So we have total financing raised to date. And then the next slide talks about the primary location of companies. This, I think, has been very interesting, that people have been, always been geography oriented. More now than ever, we see 91% of the companies in the United States and Northern California, and the other usual suspects of like the Northeast. Texas has grown. And we are not seeing geographical differences consistently. We see geographical differences can be impacted for certain jobs if you're in a hot market. And I'm going to keep moving into the data because, Melissa, I know that you'll be able to speak to that. But the reality is that most of despite the fact that the geography can sometimes matter, it just is not always a guarantee. In terms of the comp levers that we look at for compensation, you have base salary, current bonus, which was an actual bonus that was given, target bonus, which is the total cash, is part of the base salary and the current bonus. So the target bonus means that that's what's out on the horizon and is not guaranteed. And then, of course, the equity levers, and Christine, I'll let you talk to this. We've got founder shares for current job, which means you have a CEO who was a founder and then they got additional equity past what they have for being the founder CEO, right, for being in the CEO role. And the non-founder equity, which means that is the person who gets hired off the street, so to speak. The next page is looking at the comp data, and this shows us for a CEO, this is all industries. I think the best way, Melissa, maybe you want to weigh in on this, is to look by industry and total financing, right?
Yes.
Yeah, and I think that is a part that, it often comes up, like people want to look by valuations. While we sort of address that
Yeah.
Yeah.
As you can tell, that could change in a week, right? So I think that's a really challenging way to look at. So we always do by equity or capital rate,
Total amounts raised.
Yeah.
Yeah.
Yeah, right. And so here's looking for all industries under 50.
And we talk about this sometimes in these panels, just to kind of level set for people who are out there, founder shares, because there's sometimes confusion about are those different types of like a different class of shares, but those are usually just the shares that a founder receives of common stock at the formation of the company. So they're fundamentally not different from other shares, except for the shares that are in the hands of the founders, and they're usually at a nominal price for purchasing.
Yeah, correct. So you can see from this slide, we're looking at the base pay, the bonus, which is an actual bonus, which gets you to the total cash. And it's not a straight addition, right? Because not everybody who has base pay has a bonus. So that's why the total cash is not adding the 25th percentile of each. And then you get to the founder total equity, which could be a combination of just founder shares, or as you're saying, it could be founder shares plus additional equity that they're getting because they're in their current role, and then the non-founder equity. Let's go to the next slide too, please. We can see that once you go to additional financing, we move to the next slide, please. Okay. All right, so now you've got a biotech executive who is in the $15 to $50 million of total financing raise. Now, biotech, you can see there's a little bit of a premium, right? You've got the 25th median and 75th percentile. And even for a relatively younger company, you can see that the total financing in that 15 to 50 is getting somebody's total cash up to $330,000. The founder total equity still could be high. So Christine, let's say this is one of your clients. What do you advise them here?
Well, again, I think it's for a lot of my clients, it's how do you maximize their equity piece of it? Because that's the upside there. So, again, thinking through the founder and then the non-founder equity piece. And to Mark's point, if they're a founder and they've been there through a certain point, is starting to get other grants as founder equity as well. And I don't know if you break that out, Jody, but just in thinking through like what was the initial grant and then as they become more of the operating CEO as a founder as well. So getting more options that vest over time rather than startup grants, I think is really important. But, my standpoint is always how do we maximize your ownership in your company and how do we maximize the upside for you? So that's kind of the stance that we always take with our clients. Which, some of the companies.
We can break it out, but I think it's, we do this in the consulting a lot. We can break it out, but it's a little bit of a slippery slope to break this out because, if a founder didn't get what they should have gotten, in the beginning, right? And then they get the additional equity, which is, despite where the bucket is, my recommendation is to be looking at this in total, because obviously the most important thing is that you have the total amount, right?
And if you're willing to give up less cash comp, you obviously want that in return for more equity, right? I mean, I think those are the ultimate levers, right? There's base pay, bonus, and then there's equity. And pulling between those three levers when you're negotiating, I think is the most important. So using this data to figure out kind of where you can sit and how you can maybe up the equity if you don't need as much cash.
Yeah, and Morgan just posted a question that is very much in that vein. Can you correlate base salary to founder shares? I would assume that those with lower base salaries have a larger portion of equity. And
not always. You would hope so, but that's not always the case.
Well, yes. And I think you really need to back up into comp philosophy before you start making a lot of these different trade-offs. There are definitely many ways to skin a cat, and many ways, some people are way more invested in higher equity than higher cash, and vice versa, depending on stage of life and their situation. But I think in our experience, we always shy away from making a lot of exceptions, and we try to stick with the data as the true north, and then try to create bands that we can fit everyone in the company into, because it's as you grow and scale, especially as you get north of 50 to 100 people, creating exceptions creates a lot of headaches and overhead for people like Mark, correct?
Mark, when you're doing you see this when you're doing a employment agreement or when you're working with a company, right? I mean, if there's been, and we see this on the consulting side, if there are grave imbalances, that is obviously an issue. But there is, I think, to answer the question though, is that you can't naturally correlate somebody who has a lower total cash with somebody who has higher equity, especially I would say arguably in this life science area. I think it goes more to, and we also do look at this, if somebody is a first-time CEO, second-time CEO, or so on, and you don't let that happen. But the biotech folks are probably the worst offenders of this because they're the most altruistic and genuine in looking at their compensation. So, I would say that that's probably the biggest area where it has to be, you've really got to watch this, and make sure that you don't get into these problems and let it slide, because if you do, like this up, is that here is the CEO by experience, right? The total cash. And you can see that, and oftentimes the folks who have a third-time CEO or more, and I think this definitely correlates to biotech companies more than it does for tech companies. Because Melissa, you see this with a tech company, right? There probably are CEOs who have the interest in taking less cash and more equity, going really high because they know there's going to be a liquidity event. But in life sciences, that doesn't happen as much, right? That is where it obviously is taking a longer time. So they can't really take that lower cash and higher equity always, because unfortunately, it just may be too long, for it to happen.
Yeah, and I think there's some psychology to it too. The nature of tech founders versus life science founders perhaps are a little more risk aggressive.
Yeah. Okay. Well, I think Miracle of Miracles here. I have managed also to pull this up. Let me take a look. Morgan, do we want to go back to the slide on the cash, please? So that would be on the biotech, $50 to $90 million in total financing. Okay, great. So you can see here what happens now. More money going in, right? The total cash is going up. So this 75th percentile is running about 5.25. And now the founder total equity has been diluted. And I think that is the biggest piece of this in terms of those of you that are on the phone, understanding that you've got to look out on the horizon of your additional financings, because when you know what's going to happen as you raise more capital, that you're going to get diluted down. And Christine, if you could talk to us a little bit about these QSBS and the terminology that we know you are so knowledgeable on.
Yeah. So again, there's qualified small business stock, which I think has become, quite popular. And I think most people are very familiar with what that is and how it works. But it really, the ultimate test is less than 50 million of assets on the balance sheet or funds raised. And that is the qualifying test. So you have an option when you come in, literally and figuratively, if you are given the ability to early exercise your stock or your options, you can start that clock for QSBS, and the hold period is 5 years. And after the hold period, there's anywhere, the first 10 million of gain is exempt from federal taxes. And then there's a ton you can do with that around gifting and layering on other trust, because it's by company and it's by taxpayer ID. So we've done a lot of really interesting techniques with clients around layering the 10 million to get to 20 or 30 or 40. And there's really a cool advantage that you can do there. Now, having said that, though, it is a cash outlay. It is still a risk, and not every executive joining or every employee at every level is given the ability to early exercise. So really kind of understanding the trade-offs and the risk return profile around doing so is key. But to the extent you can, it's a really great tool. Now, there is some question it's always been put in and taken out of kind of the tax law changes as to whether or not that will continue on. But for now, it's there, and it's certainly something that is it's something and a consideration that everyone should be aware of. The other thing is really just understanding what you own. And the difference between whether you really do have shares or you actually have options. And if you have options and you haven't exercised them, those are not shares. And then if you own options, are they incentive stock options or non-qualified stock options? Because those are actually taxed in two different ways. But if you have a mix of both, there is an opportunity where you can almost play off of the two if you decide to exercise some, because one tax is due during ordinary and the other one tax is due if you're in AMT. So there's a little bit of like just expertise that you can do to kind of calculate around if you're exercising some and pulling yourself out of AMT, so you owe no tax on those exercise of ISOs. So that's a really kind of interesting technique and tool as well. And then just really, again, understanding how to continue to optimize what you own. And it's not just maximizing your ownership, but really understanding it from a tax standpoint, because you can own a large amount. And if you're taxed at ordinary income at the end of the day, owning less and being taxed at capital gains may be more advantageous. So there are different levers, and you should just be aware of all the levers that you can pull as you're negotiating your compensation early on and then going forward. And as you go on that path towards public company executive, it just gets, and Mark, I'd love you to jump in on this, right? It just gets more and more difficult to negotiate your comp, to change your comp. And with the changing rules around 10b5-1 and the ability to liquidate your ownership after you go public, there is the consideration that we've been advising our clients on. It's just thinking about at the last round prior to an IPO potentially taking a large chunk off so that you don't need to sell for the next few years post, so that you can give yourself some breathing room, because we always say an IPO is not really ever a liquidity event for a CEO or a Section 16 insider. I don't know, Mark, if you want to jump in on that.
I just comment quickly, and this kind of also relates to the incentive stock option, non-qualified stock option.
Yeah, Morgan, can you pull up the what type of awards you currently grant slide, please? I think that would be helpful as well.
Yeah, so one of the things that Christine was saying was, in terms of your strategy, in terms of do you exercise, early exercise, and incentive stock option. One of the big things, one of the big things about incentive stock options, there's no tax event when they're awarded. There's no tax event when you exercise them, and then everything's capital gains once you sell them. However, it is subject to alternative minimum tax treatment after you exercise. And
what, Christine, you call AMT, right?
AMT. So the big thing you need to remember if you have incentive stock options is that you have to hold them for a year after you exercise them for you to be able to continue to get that benefit. What happens with a lot of companies that go public is people think, oh, I've got incentive stock options. We're going to be public. There'll be a market. I'll be able to, make money on my incentive stock options, subject to 10b5 trading plans and all of that. But if you don't exercise them early enough, then you end up exercising them, having a huge AMT tax that you need to pay. And then I've seen individuals that have had to then sell some of those shares that they received upon exercise. Well, guess what? If you don't hold those for a year, that's disqualifying, and then you no longer have an incentive stock option. It'd just be a mess. You need to have someone like Christine to talk.
Exactly. That's what I was just thinking to myself. Is literally the most important thing is that you make sure that you are planning for this, because if you're not doing the planning, then you are really leaving yourself very vulnerable to these issues. And you can see that mainly people are having incentive stock options. I don't know, Melissa, are you using restricted stock very much?
Well, if you look at what happened to Stripe, that would be a real example of kind of how it can go wrong before you IPO to start doing RSUs. So we pretty strongly discourage it unless we're quite sure a company is going to go public. It's created a huge tax liability for Stripe and super complicated to manage. So highly discouraged by us. Obviously, we don't prescribe that, but we do try to make our companies aware of kind of the real dangers of doing those programs, and they're very costly. So you need to be in a very strong cash position to be able to take that on.
Right, because I think that's the biggest piece of this. We're seeing that it is the different tax implications. I mean, we had several reporter calls. I was quoted in a Financial Times article talking about Stripe and restricted stock just to see how the impact of it and how prevalent it is. But as you can see from here, that it is not very prevalent that this is happening, right? You can see restricted stock, and this is where the Marks and the Christines of the world, okay, here is also to look, that would talk about the different tax implications and how also it's structured on your balance sheet. But you can see here what type of awards do you currently grant by total financing, that it is predominantly incentive stock options, and those are also very typically time-based. Let's go. This is a couple slides down later. It says, do you provide vesting in your equity awards? And that is yes. And then the next slide talks about how long the vesting is. And here is the data that we pull as the RSUs included in awards, that the sample size is 22. So it's a relatively small number, but it's typically a 4-year vesting. And it's a 4-year vesting, and it's typically a 1-year time-based vesting, and then it's a 1-year cliff. It's come up, I don't know, Melissa, have you seen this, that people have expanded the time for vesting, into 5 years?
Yes, we've seen all sorts of things recently. We've seen a lot of requests to extend exercise periods,
Right.
With people being laid off. All of these are not simple issues to solve, so they all have consequences. So we aren't seeing a huge amount of extension of vesting periods. We are seeing a trend where some companies are getting rid of the 1-year cliff. So I'd say those are, and then, requests from, especially from, C-suite to extend their exercise time.
Right. Extend it to what?
Well, we've had requests for up to 10 years, but we don't typically want to do that.
Right.
I will note that if you extend it, it's no longer an incentive stock option.
Yeah.
Right.
Yeah, explain that to us.
So under the incentive stock option rules, the tax rules, it says it has to be exercised within 90 days after termination. So that's why most stock options, whether they're incentive stock options or non-qualified stock options, the norm is just to have it be exercisable for 90 days after end of service. If you have an incentive stock option, and it will have that 3-month exercise period post termination, and you extend that beyond 3 months, then it is disqualifying under the tax rule. So it will no longer be an incentive stock option.
Right. I'm going to go a little bit now to some tech data. Can you see my screen?
Yes.
That's a miracle. Only took me 40 minutes. Okay, so here's the tech data. I know that people wanted us to revert back to this as well. So this is we had showed the biotech data. So this is the tech data, because I know we've got a nice balance of people on the phone, who are dialed in here as well. So you can see that the total cash, and again, Melissa, I'm sure this is your experience as well, is that the tech folks make a little bit less in total cash, and that the equity has now been pretty consistent between tech and life sciences. But just tech executives tend to have, at an earlier stage company of this under 15 million, less of a premium on the cash. Yeah, and here's the next stage, the tech 15 to 50 million. Now you can see the 75th percentile is 320, and that founder total equity at 24%, and the non-founder equity. I think this is where we see that the non-founders coming in and tech companies are a little more sophisticated in terms of their equity than a biotech executive is. So listen, we throw this out here just because we're trying to make sure that those of you that are on the phone and seeing this information, that it's bringing to mind for you the kinds of things that you should be looking at as it relates to your compensation. And understand, I think most importantly, that there's not necessarily a correlation. The data gives you a sense of the speed limit, but how fast you want to go and what car you want to drive is really up to you. And I think the other piece of this that we're really making sure is that you understand the planning is very important. So here is I'm going to jump from this to, here's a CTO role, which I really think this job is very interesting and becoming more interesting because it's starting to be used. We have a CTO role for a medical device company, or it could be healthcare services, or it could be robotics, or it could be a pure consumer play. So you're seeing here the total cash And the equity, the non-founder equity, is now getting up to, could be over 1%. This is 90 million plus in total financing. Melissa, are these numbers jiving with what you're seeing, or are you still at these very high, much higher numbers than this?
No, I wouldn't say that. I think these are consistent.
Yeah, great. Okay, perfect. So, and also, as you were saying, and I think this is important to note, that there is a correlation between the comp philosophy, how you're paying the CEO, what the prevalence is, where the emphasis is, it on total cash and equity? Is it one in lieu of the other? Because how you're focused on your executives, your chiefs and VPs, really sets the stage for who your number one is, who your number twos are. And usually, if you're with a tech company or some medical device company, the CTO role can be very prevalent. Here's a VP of engineering, all industries, right? We know that people like, but you can see the non-founder equity is at 1%, right? And here for the median, and here's the CTO at 90 million plus, right? This is all industries and all financing. So it is tricky. You really need to know, if you're going to look at a broad scope on this, that obviously the more money that goes in, that equity becomes more valuable. And that's where, as Christine discussed, you really should be planning, right? Because looking at your equity, the minute you figure out what you own and how you own it, it's really can go into where you are at liquidity. And Christine, when you look at these numbers, it wouldn't, and you see the differences here, this is where you would know exactly that probably this VP of engineering is with an earlier stage company, right?
Yeah. Yeah, because of the
That's
amount of
where
equity.
Mark, we have a question that I think would be great for you to answer. So the question came in is, what happens if the company does extend the exercise period and the stock, the employee takes advantage of that extension? What are the consequences of that for the employee?
An ISO, Mark. So
Yeah.
if it's an ISO and it's not, and they extend the period beyond 90 days, what happens?
Right.
You're on mute. Sorry, Mark.
Ah,
That's a disqualifying disposition, so it's
Yeah.
no longer an incentive stock option. So, and I talked about how you get, no tax capital gains. For a disqualified incentive stock option, which is now non-qualified, upon exercise, when eventually the exercise happens, at the time of exercise, the difference between the exercise price and the fair market value at the time of exercise is ordinary income. And then any gain after exercise, after you sell it, that is capital gains. Usually what happens, though, if somebody's going to extend an exercise option or extend an option exercise period, what they're waiting for is an exit. And so if it's an M&A exit, which currently almost all of them are, but even generally when the IPO markets are hot, most exits are M&A exits. It's usually just an exercise and sell immediately, or in fact, really what happens in an M&A event is they just cash out the option holders with a delta equal to the what they would be receiving for the stock minus what the exercise price they would be paying is.
Yeah.
So
it just flips to a non.
It ends up being all ordinary
Yeah.
income.
Yeah. Well, again, we could keep coming back to this. It's like we've been doing these for 15 plus years together, and every single time it comes back to Christine saying, and us saying on Christine's behalf, that the more planning you do, the better, because despite the fact it's not only what you own, but it's how you own it. And to minimize the tax, you can do some gifting and other tricks that allow you to try and have that wealth creation and have as much as possible be capital gains.
Yep. The tax is tricky.
Right. Here's the extended post-termination. I know this came up. Melissa, you're not seeing this too much anymore, are you?
We have been seeing a lot of requests for this. So that's what, we were saying with a lot of the layoffs, people have asked for extensions, but I think they're unclear on the consequences.
Yeah, so here's the 10 to 12 months. Let's talk a little bit about option pools and what goes on here, because it comes up all the time. So here's the percentage of ownership. This is the option pool. And as you would think, the more money that goes in this employee pool typically stays in that 10 to 15%. And the founders are higher. It's earlier stage and the investors have less. The board member here is an outside board member, and I know we've got some folks who are dialed in who are looking to be outside board members. And here's the next stage of the, so regardless of how you look at this, this is biotech industry across all total financing. This is the ownership, you know, the founders, if the impact when you raise more capitals, the founders go down and the investors go up, but the employee pool is still somewhere in that 10 to 15%. Mark, is that what you're seeing in your experience when you're looking at option pool information? I mean, we see, and our goal is to have that 15% with when we're working with consulting clients.
Yeah, you know, what's interesting about this is founder stock, the far left one is usually common stock. And so it's actually not considered kind of part of the pool. However, employees and board members usually receive options or equity grants out of the pool. So if you add those two together, you can kind of see what those percentages are. And I've actually seen the amount of the pools kind of going down over the past decade or so in terms of, sometimes it would be 20%, and now they're kind of, smaller sized pools. They're more judicious about giving equity out.
We're seeing this in consulting a lot. Melissa, what were you going to say?
We just got another additional question. With the down rounds occurring, does it make sense to exercise options if the exercise price is lower than the price when awarded?
That's a very good question. What we're seeing a lot now, we haven't talked about 409A valuations much, but that's currently there. It's very inexpensive to go out and get a third-party valuation firm to determine what your exercise price should be. And what's happening with down rounds is after a down round, you'll get a third-party valuation firm to come in and give a 409A valuation. And the down round ends up making the exercise prices for future grants lower. So what we're seeing is companies saying, hey, I've got people with underwater options now. Can we reprice those options? So that's one way to address the down rounds, is having the options repriced. It's easier than it used to be. In the past, you used to have to wait 6 months and a day to do a repricing, but you can do those more effectively now. It does have impact to everybody on the cap table, but that is a way to address what's happening in down rounds.
Yeah, I mean, that's why we feel like it's so important when you're looking at compensation that you look at the industry and total financing for chief MVPs versus looking at the valuations, because that can really, and I know, Melissa, this has come up, and I've come to you several times to ask you this, where we have clients who want to put value on their equity and looking at a formula. But for what we've seen in the market now, it's even trickier than ever to include that as part of somebody's compensation, right?
Yeah, so you never give a clear value. You can give guidance on what if scenarios, but you never want to write down, a clear value statement.
Yeah, exactly. Okay, so on the option pool, Mark, if you wanted just to walk us through the rest of this, the percent of fully reserved capitalization. So this is reserved for future option plan annually in refresh grants and in new hire grants, and what you're seeing along these lines today.
Yeah, the reserve for future option plan. So when a investor comes in, or when there's a new round that comes up, usually you set a lot of things like, well, what's the pre-money valuation? How much money is coming in? Usually there's also an increase in the option plan because you're out of options, right? And so what you're really looking for isn't the total size of the plan, but how much do you have reserved left? And I'd say, yes, 7% seems exactly what we're seeing in terms of deals, where they're saying, make sure you have 7% reserved to take you to the next, whether it's an exit or the next financing round, let's say 18 months, that should be enough to kind of cover it. The refresh grants isn't something that's usually budgeted out. But it's interesting that you have the data here, because that's kind of when equity percentages get out of whack for some reason, either because you've had a down round and now the common has gotten really reduced significantly, or you've had somebody who's kind of doing more now that their equity is somehow out of whack because they've moved to a different position in the company. And then new hire grants is obviously just something that you kind of want to budget out for the time period in which your new financing will last. So typically we say 18 months if you get a new round in, that you'll want to budget out for 18 months of option grants.
We did have a question on the individual board members, from what's here. So no, I mean, it really, we do have this in-depth data. I don't believe that I have it in the deck right now, but for outside board member compensation, it really does, it can be a mix of annual equity or one-time equity, and that juxtaposed against whether there is cash. We generally see that biotech companies are on the outside board members. They oftentimes want cash because they come either from a medical environment where they're used to having some remuneration in addition to equity for their time. Melissa, I think you would say arguably on the tech side, that's rare. Mainly outside board members who are not investors are typically just getting equity, correct?
Yes, we do not give cash typically until a company IPOs, unless it's maybe an audit chair who's doing a lot of work prior to an IPO.
I'm trying to see, I might have, oh, here we go. I do have the data. Okay. So it could be a mix. And so these are how the levers work together. So it depends. So like for tech, you're seeing that it's very rarely 3 levers, the annual cash, one-time equity, and annual equity, but it's usually some version of an equity formula for tech companies. And we see this time and time again. And on the biotech side, it's more of a mix. It can be annual cash, and I think that's exactly right, about $30,000, and then getting one-time equity award of typically 0.5%. If it's an earlier stage company, you're coming in, it's riskier, and they maybe don't have cash to give you, then we see it upwards more towards that 1%. And I think that's very common. We've seen this year and year again. That's the tech. And right, so the biotech is if they get annual cash at all, but it's usually just the equity. I mean, this is
one thing to point out real quick. It's on your slide. It's non-investor, non-employee, non-investor members of the board. Sometimes companies don't even realize that. So the investor directors, the ones who are representatives of the Series A or Series B, as well as the employee, the CEO director, they're getting compensated otherwise. So you're just talking about outside board directors.
Exactly. We are not talking about founder CEOs. That's exactly right. And we can see if someone is double dipping and the numbers are the same, and this because the survey and the platform are now all in one place. So we see everything together, and all of this information is coming from our live surveys, as we said, updated on a regular basis, could be even weekly, if not monthly. And
we have one last question,
yeah.
Mark. I know we're coming up to time here, but the question was, can Mark give an example of one or two potentials for carve-outs? He referenced this in his opening remarks.
And this, Mark, was when you talked about just the refresh and the round of valuations coming down, and so we're seeing more of the management carve-outs for deals.
Yeah, I think actually the slide you just had up actually addressed some of that. It's not this one, but I think you had a carve-out slide that talked about yeah, there it is. Key insights on. So what is a carve-out plan? It basically is saying if there's a deal, an M&A deal at above a certain valuation, in order to incentivize management to get that deal to happen, because they may not otherwise be able to participate if all they have is common stock and there's so much liquidation preference above them. In order to incentivize them to get to that exit, there is a carve out, some percentage of the proceeds of an M&A event will be carved out, and then that'll be dead. It's a promised compensation, so it comes above all the equity. So that's the typical way to handle a carve out plan, and you've got 9% of the deal proceeds is one way to do it. Usually it's allocated to management, and then within management it'll be depending on who helps the most. It'll be figured out around the time of the M&A exit. So that's you have a lot of slides on this. I think that probably addresses the question. There are variations of it where you have some that comes in before, some that comes in maybe as preferred stock, but those are a little bit more complex. I'd say that the typical one is just net proceeds from a deal, and that comes out ahead of time.
Right. And you can see how this is, I mean, the year over year, looking at net proceeds, gross proceeds, or both, who participates. It's typically key employees. And you can see, right, the key employees, 30%. What we've seen, Mark, and I know it's not an absolute definitive, but typically you want to try and make sure, which just goes to the very essence of this, is making sure the percentage of equity that people have is part of their job, and takes into account if there's dilution. We typically see that as a metric in terms of the carve-out plan, what percentage they're going to get as well. Like there's consistency all the way through. So if a CEO has 10% equity, that when they come to a piece of the carve-out plan, that we've seen that being used as a barometer. Is that something that you think is safe to say, or it really depends?
Usually the carve-out plans are drafted so that there's no kind of double dipping. So to the extent there's that they're getting their percentage of proceeds. Let's say it's a tremendous valuation and everybody's clear, all liquidation preferences are clear. If they would be more getting whatever the percentage of proceeds are just simply from their equity percentage, then
right, but it would be consistent how you come up, since let's say the equity is completely underwater, then what percentage of the deal proceeds? It would be ideally used as a basis for what their equity percentage was, is what they would get as part of the carve out. Yeah. Listen, we covered a lot of information here, and as you can see, there's a tremendous amount of information, and the data is great, except that you also have to have the experts around it to know how to use it. We always say this, but it's extremely true. Christine, our fearless leader, any wind up here for all of us?
I mean, we say it all the time, right? But the tax laws are constantly changing. In fact, for all of you in California, you've got a little reprieve until October. So go buy a 6-month T-bill with your tax money and get 4.8%. And just, really make sure you understand with the changing laws, and it's really important to understand what you own, the taxation around it, and the risk reward trade-off of the decisions that you make. But ultimately, I encourage all of you also to make sure you take care of yourself, because so often everyone assumes you're going to be taken care of. And most of our leaders often want to take care of their team first, and then don't spend enough time on their own comp. So that is my advice, and use the data to drive what you are negotiating in.
Yeah, Melissa, you're in such a bird's eye view. It's such a, A-level firm, Division I firm, and you getting to have access to deals in addition to talent. What's the number one takeaway that you would echo here?
I think, steady nerves in this market are really important. Not being overly reactive, anchoring yourself in data, and really consulting with your legal and tax team is mission critical here before you make exceptions and create more problems for yourself.
Yeah, Mark, any parting shots? We're right at 1 o'clock on the money here.
No, just that I think generally the people I talk to are optimistic about the future in terms of exits, capital markets coming back at some point, M&A valuations all going up at some point. So in making your compensation decisions, basically what Melissa and Christine were saying, look at the data, rely on experts, but also think about things long term, because things will be looking good, I'm sure, in the next year or two.
Yeah, I think that's tech and biotech and health services are not going anywhere.
No, they're not. And the data shows that. I think more so we're seeing consistency in the data. There have been, we're looking to see if a job's gone up or a job's gone down. We have to hunt to see where the medians are moving, and they're not typically moving very much, but mainly it's how you're using percentiles. And I think back a year or two ago, there was a lot of use of 75th percentile and max numbers. Yeah. And now things are sort of moved back to the middle of the medians and the averages. But the numbers in and of itself, it takes a lot of data to change those numbers. And the market is still, as Mark is saying, very steady and stable. So on that note, appreciate you all being with us. There will be a follow-up. We can send the recording, also a survey link, and everyone gets access to a subset of the results. So we would love to have you all participate. And again, if you have any follow-up questions, feel free to send them off, and we'll make sure that the right one of us gets the response. And thank you all for being here.
Thanks, everyone. Great to see you.